Today, I want to cover three topics that we're having a lot of conversations with about clients. Number one is Warren Buffett and the amount of cash that he's sitting on, a little higher than usual. Number two, interest rates have fallen. What does the economy look like? What does that mean? And three, with falling interest rates, how does that affect stock and bond-based investors? My name's Joe Conroy, certified financial planner with Hartford Retirement Planners. Let's get right into it. We've gotten a few phone calls about this one. Warren Buffett is sitting on an incredible amount of cash. How much cash? A lot of it's in T-bills and things like that, but the amount of cash is close to $190 billion. That is an eye-opening sum of money. But let's give it a little context. So that equals about 17.5% of Berkshire Hathaway's balance sheet. To give you a little extra perspective, typically since 1997, the average amount that he keeps in cash in Berkshire Hathaway is 13%. So right now it's at 17.5%. The average plus or minus is 13%. We're not that far off. It is a little bit more than normal. It did peak in 2004. He had 40% sitting in cash. So it's gone up to that amount. So should we be worried that Warren Buffett is sitting on so much cash? Does he know something about the economy and his future that we aren't aware of? And should we know something? Or does this mean that the market's going to drop and he's just waiting for it? Well, no, because half of that cash is really earmarked towards losses related to the insurance-based business. So Berkshire Hathaway owns a portfolio of different companies, and insurance is a huge part of that. And insurance companies have large capital reserve requirements in case there's a bunch of claims against that company. They need to be able to pay out the insurers. Half of that cash is really earmarked for reserves. The other half can be deployed. It's a little bit higher than average, but not a number that should make our eyebrows go up and make us head for the hills and sell everything. Keep in mind that when Warren Buffett is buying investments, it's a lot more difficult when you're moving $50 to $100 billion in publicly traded stocks. It's not like your average person buying $5,000 or even $50,000. When you buy $1 billion of stock, it moves the entire market, and he's got to be careful how he deploys that. Second topic is interest rates. People are fearful that there is a recession, although we just had a recession in 2022 as defined by 2 quarters of negative GDP, gross domestic product. And we had another recession in 2020 with COVID. There were 2 quarters of drops. So we just had back-to-back recessions. Most experts have low concern that there's going to be a recession. Now, no one can predict the future. Anything is possible, but the economy does appear to be on strong footings. Unemployment, while it has ticked up slightly, is still historically low in the 4.2 to 4.3% range. Let's compare that with the 50-year low that we experienced just last year of 3.8%. So yeah, unemployment has increased, but its increase is still near historic lows. So it's not a huge concern factor as it stands today. GDP growth. In the second quarter of 2024, GDP grew 3%. Remember, we define a recession as 2 quarters of negative growth for GDP. So we're positive 3%. Anywhere in that 2 to 3% is a generally healthy, sustainable number. So based on jobless claims and based on GDP growth, things look like we're on solid footing. Interest rates are dropping, so the Fed cut them 50 basis points or 0.5%. So that Fed target rate is now 4.75 to 5%. Let's add some history to this and some context. So what does interest rates dropping mean for your average investor looking to stay retired or looking to get ready for retirement? Well, since 1984, there's been 7 rate cutting cycles. Out of those 7 rate cutting cycles, 4 of them were after a recession had already occurred. It was trying to get the economy back on solid footing. As I just explained, that really isn't the case this go round. So what happened in those 3 rate cutting cycles when the economy was on a relatively strong foundation? Stocks did very well. The S&P 500 averaged 27% positive returns from the time that the first rate drop started to when the cycle ended and the final rate drop occurred, positive 27%. Now, I'm not saying that stocks are going to go up 27% from where we were a couple of weeks ago when the Fed started cutting rates, but what that means is we shouldn't be so nervous to be stock-based investors. There's always going to be reasons to be stock-based investors. We're always nervous of a recession or something happening, but Rate cuts in a strong economy, usually a good sign for stocks. What about bonds? I think a lot of people don't really think about the bonds in their portfolios, even though as you get closer to retirement, it usually is a large portion of your investment assets. So when rates are going up, like we saw in 22 and 23, it had an inverse or negative relationship with bonds and bond prices. So as interest rates are going up, the prices of the bonds we had in portfolios were dropping. Why is that? I'll give an oversimplistic example. Let's say you bought a bond at the beginning of 2022 and it paid 4%, all right, 4% coupon. Well, as interest rates are going up, new bonds are being issued and they pay you 5%. Who wants to buy your 4% outdated bond when I could buy a new one at 5%? So if I am forced to sell for whatever reason my 4% coupon, I have to discount the price to make it look like a yield of 5%. That is the challenge we faced these last couple of years with rising interest rates and fixed income investments. Well, now we're starting to see things go the other way. As rates are dropping, and let's say the 4% bond that we bought, and now only new bonds are being issued at 3%, just for illustrative purposes, everyone's going to want that 4% bond. Now your bond commands a premium because the new rates are lower. Does that make sense? So with lowering interest rates, you have the potential for price appreciation in addition to that yield with bonds. So what? What does it mean? I'm just planning for retirement. I don't want to work forever. I want to stay retired and maintain my own decision-making ability, my independence, right? Economy appears to be on solid footing. Rates are dropping, and that usually is a good mix for stock and fixed income-based investors. I would mention the election because that is definitely the top of most people's mind, but I've done several videos on it. They're on our YouTube page. So look up Hartford Retirement Planners and you can watch those videos. It is a concern, but if you don't feel like watching the videos, what I will tell you is that it really hasn't had much of an influence on investors when we're going back to the 1930s. So it is a concern politically, but don't let politics dictate your portfolio. So that's all I'll say about the election. If you have any questions about Warren Buffett's cash or interest rates or your investments, please give us a call. We'd be happy to have a discussion with you. And as always, thank you for watching.